Welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser, and I'm so excited that you are joining me. I want to talk to you today about 2023 and what can you do? Don't be scared. Things could get ugly. How do we prepare for that? How do we, mentally prepare for that? Because I think that's the biggest thing that most people and most investors don't prepare for is what does it feel like when you're actually losing money in the market, and how and what can you do about it psychologically? And then, where do we go from here? Because the year could take us any number of places, and we have a good sense of where we're headed, but let's talk about it. So I want to get into, first of all, what happened in 2022. As you guys know, I've shared with you multiple times that we informed our client and our client base through our wealth management firm that 2022 was going to be what we called a mean reversion year. In other words, we had pumped in so much stimulus in 2020 that we knew that in 2021, when the Federal Reserve was saying, and Janet Yellen was saying, oh, this inflation is transitory, we knew that it was not transitory. And in fact, this was going to be embedded entrenched inflation because of all the factors that we had just had way too much stimulus in 2020. I've done multiple podcasts showing you guys the jump in the money supply in such a short amount of time. Within a matter of 3 months, our money supply absolutely jumped massively. And I've shown you the actual Federal Reserve charts to show you that. And so we knew that the inflation was not transitory and that it was ingrained. Although 2021, we still had positive GDP over 5, almost 6% GDP in 2021. And so we still had some things going well for us, and the markets overall obviously did quite well. When you look then at 2022 and you start to see, okay, now inflation really has a massive impact. And then you start to see what has happened in not only the financial space, but the big tech space, with a ton of absolute jobs being cut, layoffs happening massively. You realize they really pushed all of this information to happen sort of January 2023. These companies knew in December of last year that they would be laying massive amounts of people off. But yet still the news was deferred until January so we could keep the GDP and everything for the US as high as possible. Now, when you look at the GDP that was just released for December or Q4 of the United States, you see that it came in at 2.9%. That does not mean the fourth quarter came in at 2.9%. That means December to December of 2021 to December, or quarter four just 2021 to Q4 2022, we had gross domestic product of 2.9%, which obviously is not negative, which would then definitely take us outside of the recession. So we had 3.2% GDP in Q3 and 2.9% in Q4. Those are year over year numbers. So basically, we're not in the negative 2 consecutive quarters, taking us out of the technical definition of a recession, which is definitely what this administration was looking for. As I explained to you in Q3, if you look at the actual sectors of Q4, you will notice that most sectors are negative, and where we get the positive is the government spending. Of course, the American, and the Inflation Reduction Act alone had so much spending that we would definitely expect to see growth. The St. Louis Fed coincidentally just released an analysis that shows that our fiscal policy, i.e. the Inflation Reduction Act, actually increased inflation by 2.6% even just last year, even though the funding had just started. So we have a lot of things going on the fiscal side and the monetary side. That brings us to this debt ceiling that we have hit now, 30, my brain today. Basically hit the debt ceiling at over $30 trillion, 31.4 trillion. Thank you, my brain. 31.4 trillion is the current debt ceiling. The debt ceiling has been raised 78 times since 1960. So this will be the 79th time that it is being raised. And what's happening now is the Biden administration is really digging their heels in and saying they're not going to negotiate with the Republican House, which has a Republican majority, by just a razor margin. So it's very possible you could get some moderate moderate Republicans that would join with the Democrats and certainly a vote to increase the debt ceiling. But you might not get that. You might have them stick together in a block and as a block be very strong about not raising the debt ceiling, which would cause us a lot of problems. Janet Yellen has put what we call the X date. An X date is the date that is a hypothetical date at which time that would be the date that the United States government does not honor by making payments its debt obligations. Either we miss interest payments, we could miss Social Security payments, Medicare payments, Medicaid payments, anything that gets missed that is part of the standard operating procedure of the US government would be very problematic for us because that would jeopardize the full faith and credit of the US currency, which has already been substantially jeopardized by many other factors, but definitely not by the United States themselves not making payments. So you do have a debt ceiling problem. Yellen has said that she's bought us a couple of months of time to still pay the bills without having the ceiling raised. She's putting the X date, the date where the United States no longer actually met their fundamental obligations at June, beginning of June, first part of June. Most analysts do not agree with this assessment, think that will be sometime between July and September, most likely August. And yet I don't think we're going to get anywhere near that because it's only January and this will get resolved. It will be worked on and will get resolved somehow. What's happening, and most people have a lot of problems with the fact that we have we're just constantly raising the debt ceiling instead of actually doing anything to fix the actual spending. They just constantly raise the debt ceiling. I think the Republicans see this as an opportunity, especially with the new Congress and them newly being in charge, to really make some change for how much money we constantly keep spending with no limits. There's seems to be no limits, especially after coronavirus. So the thing that you have that's a big problem is you have quantitative tightening. So the Federal Reserve raised interest rates last year 7 times, and they also they stopped stimulating, as we know, but now they're actually going to QT, quantitative tightening, and they want to run off about up to $95 billion a month from the balance sheet. So that is a liquidity suck from the economy, because if they are selling $95 billion of bonds off of their balance sheet, that means that they're receiving the cash and selling out the bonds. So it's a liquidity suck from the Federal Reserve running off the balance sheet. If we have that happening at the exact same time that we've reached our debt limit, and we have that liquidity being sucked out of the economy, this could create massive liquidity problems. And you guys know I've talked about in 2022, liquidity being the actual crisis that could cripple the dollar at any given moment. You must have liquidity. And the problem is with our US system, we have been a stimulus economy probably since at least 2000, but let's even just say since 2008, 2009, since the GFC. We have completely been a modern monetary theory based economy, 100%. And that means that we are constantly looking to have GDP by pushing stimulus into the economy, low cost of capital, next to zero interest rates, and massive stimulus being pushed in through the Fed on a yearly basis made the markets come up, 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 and up. And that's why we don't have a true organic sense of where they are. So if you talk about liquidity events where the Fed is no longer stimulating, they no longer have a low cost of capital, they're sucking liquidity out of the market because of the fact that they're running off their balance sheet. And then at the same time, you're also talking about running into a debt ceiling problem and having to finagle ways to cover our bills until we can actually get a new ceiling approved through Congress. You're talking about a lot of things that are butting up against each other, causing a lot of problems. So just be prepared, you guys. 2023 is going to be rocky, and I don't think this is the year to go it alone. You absolutely should seek professional management. Seek management that is not going to just toe the standard line of stay in the market. You can't pick the winners and losers. You have to stay in the whole time. This is going to be a rocky road. And if you don't have the risk tolerance to lose lose 30% of your portfolio, this is probably not the year to start off in equities. I would definitely remain in a dry powder situation. Look at commodities, look at metals, look at things that we think no matter what happens with China and no matter what happens with Saudi Arabia, these asset classes will still perform. You need to be hedged into safety asset classes that will get you bridged from where we are, which is an oversold market, totally overbought, totally too high, still needs to come down substantially more. But it's going to be painful because it's going to happen either through war escalation, Saudi Arabia pulling the trigger, something out of China. All kinds of things could actually make this year go a little bit crazy. But the point I'm trying to make overall is this is not the time to go it alone. These are some of the most difficult economic conditions we've ever had. And I've never seen so many analysts really just tell you, we just don't know. We've not been here before. And that's where a lot of analysts are ending up. This is from top to bottom. The market does not have a sense of itself, and it's to be determined. So we don't have a consensus overall on the market going up, going down. It is a really mixed bag. And analysts just don't really know what to make of everything right now. But I will tell you, the geopolitical risks are imminent, and they're bigger than just traditional microeconomics on stocks and returns. So until next time, you guys, I hope you enjoyed this edition of Crashes and Taxes. Take care. You can always reach out to our office at walserwealth.com, but otherwise definitely seek professional management and don't go this 2023 alone. Take care, everybody.